People often ask, what is the difference between an interest payment and a dividend payment? Well, to the average investor, they're actually pretty much the same, even though there can be some tax differences under current tax law. But technically speaking, an interest payment is from a debt instrument. It's when you essentially loan money to an individual or a company, and you get interest in exchange for making that loan. In the corporate finance world, a bond is a great example of something that pays interest, because when you buy a bond, you're lending money to an issuer. However, when you own something and you get an income payment from something you own, now that becomes a dividend. So the most common example, of course, is when you own a common stock, in which case you actually own a chunk of that company versus, as I mentioned a minute ago, with a bond where you're lending money to that company. So if you own the stock, you get a dividend. If you own the bond, you get an interest payment. And then there are some hybrid things in the middle, such as preferred stocks. And although we always talk about how preferred stocks are more bond-like than they are stock-like in many ways, because they're technically considered a class of stock, they also pay a dividend. Now, the interesting thing is some things that pay dividends, like a lot of common stocks, pay something called a qualified dividend. And what a qualified dividend basically means is it's taxed at a lower capital gains rate, whereas interest is always paid at ordinary income tax rates. So again, interest and dividends are really very similar because it's an income that gets paid to you from an investment. The difference is largely semantics, but also can have significant tax implications, especially if you're in a higher bracket.